Please, speak as you might to a young child or a golden retriever. It wasn't brains that got me here, I can assure you of that.
And it's a brand new year, so welcome you all back for another weekly market recap. Although, again, shortened trading week because of festivities, we got the New Year Eve basically in the middle of the week. And of course, the market was closed on a Thursday and back up on a Friday. But realistically, I guess the majority of people and participants will be back starting next week. And next week will be the first complete and full-on trading week with no, pauses in between. So we will have a much better pulse of what the market might wants to do, right? So I guess, again, another one of those videos where there is really not a lot of substantial to be discussed. But nonetheless, we are here, so let's jump right into it. As you can see, the background is changed. Once again, we got back to the usual boring stuff. Now, as for the economic calendar, we didn't have a lot this week, so I'm not really going into it. If not, do you want to have a look at the initial jobless claims? Well, they kept on going down. And therefore, they picked and they're still coming back down. Same for the continuing, which is, you see the top in here, slowed down. And it looks like, again, it keeps on going down for now. Although, historically, we are still at high enough levels, right? And as for the 4-week average, we are in the middle compared to what we've seen over the last 3 years, more or less. So, not a lot. Next week, I think it's going to be much more interesting. I think we're going to end up the week with NFP. If I'm not mistaken, we're going to have ADP early in the week. And as you can see in here, the job openings. So I think maybe next week we are gonna, we're gonna spend a bit more time on the economic calendar. But this week, don't really feel the need for it, right? So let's keep moving with the usual introduction. Break-evens still down overall. If you look at the overall trend, so disinflation to say the least, because if then you check the alternative sources of data like Trueflation. As for PCE, again, huge drop. And it looks like it's now around 1.8%. Wow. As for CPI instead, 1.8. Again, with a slight approximation, as you can see. But anyway, so, last time I checked, the latest official headline data as for the CPI was what? 2.7, and it was expected at 3.1. And now since the government is, of course, vastly underestimating inflation, therefore, the CPI, it's not really 2.7. It's probably is going to be around what? Maybe 3.5, who knows? So these much more trustworthy sources are saying that actually inflation, it's way lower than what the official data are telling you, although they are overestimating it. So where's the truth? I don't know. I think at the very best, the official data are lagging. Do you want to trust these ones? Well, maybe. I like these ones more, but they are not telling you the story of runaway inflation, tariffs. The Fed is going to cut rates, therefore it's going to be inflationary and all the rest. But I guess that is a story for 2026, for the entirety of the year. We'll see how it plays out. Although, just, remember when we're going to check yields later on, there is a little bit of a discrepancy when you look at these data points right here, and when you look at how yields behaved this week. Just keep it in mind, right? GDP now, nothing changed. They're still 3%. Next update will be January the 5th, as I can read in here. So, all right. Fed Watch, we are, 25 days out from the next Fed meeting. 83% no cut. I think there will be cuts, another 25 basis points. That would be my bet. Again, because you keep on looking at inflation data in real time and you keep on looking at the labor market weakening. So I guess a huge decisive factor might really be what's going to come next week, right? With NFP, unemployment rate, and ADP reports and all the rest. So, I think the duality of the mandate will be impacted next week because, inflation, it's not longer a problem. And those trustworthy sources are confirming it. So if inflation is not a problem and you see the other side of your mandate, aka the labor market, it's keep on deteriorating, well, at that point, there is space for another cut. And we already see the shift in the tone over the last 2/3 FOMC meetings, where at the very beginning there was a lot of dissent, and then if you read the latest one, there were just a few dissents. So even those stoic oaks are kind of turning into doves at the very end of the day. But again, we'll see. That's a story for the end of the month, most likely. So the credit spreads still on the floor, so not signaling major worries for now. Although, again, keep it in mind, we are going to get back to it when we talk about bonds and yields. I think there is a little bit of a risk and something that maybe, I'm not saying you should be worried about, but you should keep on monitoring, right? Just a spoiler alert, it's in the repo market, right? And so other than that, there's really nothing else to be discussed. Let's jump into the chart straight away, all right? Good old charts. Let's start out with the DXY. And as we can see, we had another tiny bounce, although still in the context of, lower highs, lower lows. We completed this swing now fully. We started out from this base right in here. We went up and we basically got back to base now. So I guess that would be an interesting point to see how the situation further develops itself. Can we bounce, maybe creating a high and resuming the uptrend, or is it going to be the another lower high, and in time we're gonna crack this level out and break below it and starting to crack the 97 and then the 96 and going for new lows? There are a lot of bearish bets on the DXY. I mean, there have been for the entirety of 2025. Of course, 2025, if you just check the index, it was, I guess, I'm not sure if it was the worst in absolute terms year for the DXY or just one of the worst years. But anyway, it was deeply negative as for, the trend of this chart right here. So we'll see next year or, this year, how it's going to play out. I think, again, up until the point it goes sideways, and especially if it stays in this range, like pretty much around 100, there is nothing conclusive to be said about that. I mean, if you really zoom back, 100, it's kind of like the mean of the entire, call it, structure of this chart, at least, for the last 10 years. So we are not really moving a lot from the mean of this price segment right here. We got our dumps, we got our spikes, but overall, we always keep on mean reverting back to these 100 area, right? Which I guess at the end of the day, whether you believe it or not, it's kind of like where policymakers would like it, right? Now, will they always succeed at keeping it where they want it? Probably not. As you can see, even in the past, we had massive deviations away from it, but so far, this is it. Now, another thing might be, since we are here and we are looking at a higher enough time frame, so this would be your DXY, a monthly chart. Let's just add back in for a minute, since we are at the beginning of a new month, the good old dollar trade, what was that? Dollar trade weighted index, which would be this one, which is, at the end of the day, again, just another index. You could also use the broad dollar index that you can find on the Fred database. on TradingView, I happen to have this one, which, you know, it should deliver the point home anyway. So the DXY, of course, being an index, it's vastly impacted by the euro and the yen. So, you know, you can just appreciate how we are kind of going back down, right? So you got your lower high on a monthly time frame, mind you, and your lower low on a monthly time frame. Although the other one is showing you a higher high and so far a higher low, although it looks a bit weak at this point. But nonetheless, this is what you have. So at the very least, you should infer that, you know, over the last 2-3 years, the DXY, it's not really all there is. It's not the all and be all, right? Again, it's because of how the index is, it's built up, right? And the different weight different currencies have into it, right? So again, I think there is not a lot more to say about the DXY. Let's just compare it with what happened in the other majors. The euro didn't change a lot. We were looking at this level of resistance in here, another tap into it, and a much more decisive pullback. We didn't, you know, on a daily time frame, we didn't break this low right here, so we're still good for staying in this range and maybe trying again higher. Especially again, it's gonna go hand in hand if a potential lower high on the DXY, right? The pound came back up again, and then it pulled back a bit less than the euro, but we've seen this trend going on for weeks now, with, you know, the pound, the British pound, being, you know, the leader and the euro being the lagger, and therefore the British pound, which seems to be a bit stronger than the euro, at least again for now. The Canadian dollar, it had another leg up and then another pullback, but still it looks like it's really, you know, going up for now. Did we hit any relevant target? Well, I mean, this point of release right in here was juicy. Did we touch it? Let's just draw a line. Well, almost there. At the very least, we closed the daily inefficiency, yeah, and then we pulled back. So, I mean, it was a relevant area. It was a logical area to, you know, to wait in order to expect a tiny bit of a pullback, especially considering how we basically shot into it very inefficiently and sharply. So, yeah, I think that was an easy one. What's next? The yen, which is still particularly weak. And again, we have been hearing a lot of the carry trade, the Bank of Japan hiking rates. And yeah, okay. Well, so far, it's not reflected in the currency. Again, we have been discussed, I think 2 weeks ago, how maybe actually the BOJ would like to have higher yields, but still a weaker currency. It's another one of those things. Can they succeed? Maybe. Historically, they are always proven wrong in the long run. I mean, it can go ahead for a while and then something happens and they are basically blown out of the water and they have to intervene with massive, you know, huge tools, a lot of money involved, a lot of injections of liquidity and all the rest. That's the history of central banks these days. But up until the point, you know, you don't see the yen really spiking again. I'm going to say it again. I ended up the year last year saying it. I'm going to begin a new year saying it. Up until the point I don't see the yen spiking, I'm not really worried about this yen carry trade debacle. And the first, you know, of course, the first stage to start to think about it would be the yen getting back above 154, 55. So up until the point I don't see that, I'm not really worried. The Swiss franc, it's still kind of the same, tested back into range high and dropped back a little bit. So nothing new under the sun. Let's have a look at the others. So the Australian dollar, it kept on rallying a little bit. Was very extended. So what we've seen this week after Christmas, I'll let you guess, a pullback, right? And what else? the Russian ruble got particularly volatile this week. I don't actually know. Again, I'm not following Russia a lot because at the end of the day, I don't trade the Russian ruble. It's here just because, there had to be 6 charts, and considering the news, the geopolitics, and all the rest, I just thought, you know what, maybe the Russian ruble. But I don't know what went on this week. Probably, again, my best and quote-unquote safest bet is always that it's related to something which happened in Ukraine or with the geopolitical landscape. Because I'm going to say it straight out. I'm not going to tell you I know for a fact something when I don't. Because other than that, I can't really find any other motivations for this type of volatility, especially in one day. Overall, let's just stick to what we know. We went for a high. It was a lower high compared to this spike right in here. And then we pushed back down. We came back up, tested this point of release, reacted to it immediately, and we just tagged these equal lows right here. So I guess the story is that at the end of the day, after that, let's just wait and reassess. Like if you were trading it, I guess the move was this one, right? Wait for the break. Look at the point of release. We have a clear draw, a liquidity, or let's say a logical spot where a lot of liquidity would rest below. So if you see rejection here, it's a nice play to wait for then price to hit this pocket right in here. Right, so that was it. The South African rand and the Chinese yuan are still going up in tandem. Probably the yuan, it's going up even more. At least, that's the impression you have by just looking at the charts. When you actually measure it, what are we looking at here? Well, 2% compared to what? 5%. Well, actually, you see, when you measure things out, the eye cannot be tricked. So the South African rand is actually going up more. But then again, that would leave you with the question, okay, but how deeply it fell before that? Yeah, it looks to me that, the South African rand fell a bit more, maybe. But again, we are not interested in a monthly chart on currencies. What else? The Brazilian real, again, it's having this nice little pullback right in here. So kind of like a little bit like the Russian ruble, although just pay attention because the fundamentals could be different. Obviously, different countries, different region of the world. But if you are just looking at the charts, whatever the catalyst may be, it's kind of the same thing, right? We came back up for a lower high in here, then we broke the structure in here and tap into the previous support, and back down we go. We take out a major low in here, but we still have this one, which, on the left of it, there are a few relatively equal lows. So let's just say if you see weakness in here and it starts to be faded, maybe this could be a good target. Otherwise, you're going to see a reclaim of this area. And I guess at that point, you might even target the upper point of release right in here for, let's say, a conservative target. If you want to get long from basically this area up to this area, maybe, right? It's a nice point because it gives you a very tight invalidation point. And, if you're wrong on the short, you can immediately try to flip long and target the other direction. So maybe, I'm always wondering who's trading these assets, but maybe not short-term traders like we, but like we do, or like I do, or like we are. But someone must do it, right? Brazilians, they do, probably they do, right? The Indian rupee, it's still weak. It looks a little bit like the yen, right? You have a little and tiny level in here, which is clear enough. So again, up until the point we can't reclaim it. The trend is down. It's been down for a while now, basically since last April. So stay with the trend up until the trend it's lasting. All right, enough with currencies. Let's have a look at oil. Although nothing really happened in oil this week. You remember we ended up last week in here. So another bounce. We tested back into the upper boundaries of this channel right in here, and yeah, we found resistance once again. Although no follow through to the downside, we kept on maintaining this point of release right in here. Or if you want to look at the bigger structure, it is sort of a base that we built up in here, all right? So up until the point we are living above it, but still in the context of this downtrend, neutral, right? It's very, I mean, I think this is very easy in the sense that if you start to see it breaking to the upside, it should be something like this, right? This is probably white now. Let's make it black, right? Something like this, and these should line up with some sort of an horizontal level, which could be this one, or even this one. It depends on how conservative or aggressive you want to be, right? But, you know, starting to leave above the diagonal and reclaiming the structure highs right in here and then breaking through this shelf, that would open up the gates for a move higher. Then again, we still have the usual problem of the key swings on a daily. So, you know, again, I keep on maintaining my idea that up until the point we're leaving below the 60s, a sustained and prolonged rally, it's not really in the card. If anything, considering that things are still playing out as they were before, maybe the logical thing to do would be wait a little bit more and see if we get really weak at the lows, and when we crack them, just go for another short. Maybe the squiggly lines came out all out of line, but anyway, you got the point, right? So we'll see. Fundamentally, I think I didn't see a lot, but again, considering New Year's Eve festivities, I didn't really pay attention, which is again why I'm, at least for myself, and again, myself, it doesn't have to be you. Maybe you have far better information than what I have, or maybe you followed the markets even more than what I do throughout this period, but across Christmas and you know, the New Year. So maybe you know something I don't. Just don't let my bias infect your own, right? This is just what I think, and as usual, I'm very open to be wrong, right? Now, let's have a look at Bitcoin instead. Now, Bitcoin, you know, in between a lot of stuff, metals, and also equities, which showed signs of weakness this week, but, you know, even throughout the Christmas week, all right? What we've seen with Bitcoin is that it managed to be relatively stable. Now, here's the catch. It might be because it came down a lot in anticipation of, you know, the stock market, and especially the tech sector, showing signs of weakness, right? So maybe this was just the leader and the others are the laggers now. But nonetheless, if you just look at it in isolation, what we see is that the level that we were talking about last week, still holding, although it's been tested many times. And every time it was tested, what you see is that we are not having continuation lower, right? And, you know, what comes out, it's something which resembles an ascending triangle, right? Usually these are reaccumulation formations or bottoming formations. So if you like patterns, that would suggest a break to the upside, and you know, the expected move should bring Bitcoin back into the 94.95, where we found resistance the last time. So, you know, on a daily, I guess it would be kind of difficult, because you know, if you wait for the daily close, maybe at that point your risk reward is too skewed and it's not even worth it to take the trade. But let's say you are trading lower time frame, right? What you could see, I mean, maybe you're trading the 4 hour or the hourly time frame, I don't know. But if you see a bullish resolution, what you could do is wait for the break right in here, wait for it to test back and target this area right here. Of course, again, it doesn't make sense on a daily time frame, but on the hourly time frame, maybe it would be a bit more granular, and therefore allowing you to identify the break in advance rather than waiting for the daily candle close. and managing risk a bit tighter compared to entering at the retest and placing your stop where below the previous trend line. That would kill a lot of your risk reward in my view. But if you can zoom in and refine the trade on a lower time frame, maybe that would be better. Now again, that's contingent on the fact that we actually break out of these resistance level. So up until the point it doesn't happen, you don't really have a trade. Just because the pattern would suggest a bullish outlook. I mean, it doesn't necessarily mean that it cannot fail. Like you can see something like that, right? So just wait it out. If you want to have a little bit of a intermarket type of view, if you do agree on the fact that probably we are going to keep on seeing weakness in other risk on assets like metals and equities, which again are assets which performed relatively good in recent weeks and months compared to Bitcoin, which performed relatively poorly in the same time span, you get back to the usual theme of rotation, right? Money flowing out of metals and stocks and probably finding a new home, which could be maybe Bitcoin, right? Although the huge caveat for me would be, look, if money were already flowing out of risk on assets, and Bitcoin and cryptos in general for me are the king of risk on assets, I'm not sure. If you had to make a list, would you put it above, below, or in the same place as for private credit, private equity, and all the rest? I'm not sure. Maybe private equity is much riskier than cryptos, but it depends on your perspective as investor / trader. But yeah, anyway. So my point would be, if money were already flowing out on risk on assets, Bitcoin went first. So now you see them coming out of metals and stocks. Do you think they're going to get back into cryptos? Or maybe they would find something, which is perceived, doesn't have to be necessarily, but it is perceived a bit more safe, like, I don't know, treasuries or money market funds. I don't know. So again, this is just mental masturbation. Again, I'm not saying that I think equities will necessarily keep on dropping. I'm not saying metals are fucked, right? Actually, I'm still long-term bullish on metals. At least to this point, we'll see over the coming weeks and months. But for now, I would be still long-term bullish on metals. But, if you have evidences of, that potential scenario being confirmed, a rotational intermarket play wouldn't be bad if it is confirmed, by TA, right? And as for Bitcoin, let's have a look at the yields. A little bit of an issue there. The house just went dark because the power grid suffered an outage or something like it. So I was without electricity for a good 30 minutes, I think, at this point. So I completely lost my train of thoughts. But we were talking about yields, or we were about to discuss yields. So let's start back from there. All right. Now, what we see in yields, especially if we zoom out, let's go on the weekly time frame just to set the stage. So you see that the medium and long end of the curve, they are staying relatively flat, right? Overall, if you look back to July, August, we are still at those levels, more or less. While instead, the short end, it's, very notably coming down. Now, this discrepancy has been explained in many different ways, at least as far as I can read online. If you have something new, please hit me up in the comments. I vastly appreciate that. But, at the end of the day, why is this? I think, one of the prevailing narratives I was reading is that what the Fed is doing right now, aka, cutting rates, starting back QE, right? It will be stimulative, but also inflationary, right? That could be the knee-jerk reaction, right? Another component of that, it could be that if do you remember last week we were talking about the earnings growth projection, right? Right. Okay. So if you think the domestic economy will perform relatively well, you should expect more economic growth. And what do we always say? What do yields represent, or what are a reflection of what? Future economic growth and inflationary expectations, right? So if we are living in an environment where the expectations are set in order to have economic growth and therefore inflation, the medium to long end of the curve should reflect that. Now, to contrast that, people say that in the short term, right, the short end of the curve is much more influenced by what the Fed is doing. So the monetary policy. And since they are signaling as much as they can, they want to be dovish, the short end, it's coming down. Now, do I think that's the all and be all that that's completely true? Possibly. I mean, I'm not sure 100%, but, if you're just looking for a reason, I think that's as good as any other, right? Now, relative to the short end alone, what I would say is that more than the Fed monetary policy and the Fed statements and all the press conferences they hold, I would think there is something which, first of all, it's data-driven, which is this one right here, right? Which, again, getting back to the beginning of the video when I hinted at the repo market, we are seeing signs of stress in the repo market. Now, I'm not going to get into it, what a repo transaction is, how it works, the dealers, the collateral, the haircut, and all the rest. It's pretty straightforward. If you check it on Google, at least, the broad understanding of it, you're going to get to it pretty quick. I mean, I managed to, so it's not impossible for anyone, right? But keeping the conversation on a very elementary level, so to speak, this is a chart of the repo transaction fails, right, over time. And when you see, especially getting into year end, right, you see that oftentimes you get a bit of that. There are liquidity bottlenecks, seasonality plays a role into it. So it's not unusual. What's unusual is to see this level of a spike in the data, right? Which you didn't see something like that since basically when? 2022. So that would be a problem at the end of the day if you think about how the system is structured and you consider that everything runs on a collateralized base these days. So, a lot of failures would suggest, at the very least, a sign of stress in the underpinnings of the repo market, aka the core of the financial system. This is where the liquidity is created at the end of the day. If you got issues in this particular sector of the entire financial world, you're going to have liquidity issues later on, most likely. Now, fails are not, again, really the ultimate indication for that. But, it's like a puzzle, right? When you start to have more than one piece, and all those tiny pieces are kind of picturing a much bigger image, you start to have, a look at the bigger picture, so to speak. So what could be something else which is interesting and would kind of confirm this thesis? Well, it would be this one. So this is basically the standing repo facility. If you don't know it, again, pretty straightforward, but it's basically a facility that the Fed came up with in order to support liquidity in financial markets when it's needed, right? So how does that work? Well, basically, you have assets, like as you can read in here, you can have mortgage-backed securities, or you could have also, treasuries, right? You go to the Fed, you post it as collateral, and the Fed basically extends you a line of credit. They give you money at the end of the day in what they call temporary open market operations. So they remove that collateral and they give you, quote unquote, money, right? Because there's still the debate about money versus reserves. But, leaving that out for a minute, just looking at that in terms of liquidity, because In this case, that is actual liquidity. If you are a bank, right, although we can debate all day if bank reserves are actual money or not, and how they can impact the broad money supply in the real world. But for you and the other banks, so inside the interbank system, they are used as money. They can be used to settle transactions. So, it's some sort of an interbank token that you can use to settle transactions in between you and another bank, if you are both banks, right? So it could be taken as a liquidity injection, right? And, you see, even in here, it's not unusual to see this facility being tapped out, especially quarter end, as you can see. And we had tiny little spikes throughout the year in 2025. What's striking is that getting into year end, especially as you can see in here, September, October, what you see then for December is that we have a very huge increase of, people actually tapping the facility in order to get the short-term liquidity they are desperately in need, which again, it's a good fit when it comes down to liquidity stress. If the Fed needs to intervene to such a degree, providing short-term liquidity to dealers, to the banking system as a whole, well, it means that things are not necessarily all well and good, right? So, obviously, since we've seen that the system runs on collateral, right? In a period where liquidity, it's a bit lackluster, and that in order to obtain fresh liquidity, aka loans or overnight loans, you need to post collateral. What may happen? What's the most pristine form of collateral? Short-term treasury bills. So your 3 months, 6 months, 1 year, 2 years bill, right? The short term. Now, there is an interesting dynamic. Now, people might hoard those bills or those short-term treasuries for two reasons, right? If you need money, or you might need money or financing or refinancing in the future, well, you need to get your hands on that collateral, because at a point you're going to need it, right? If you need money, if you need credit, you're going to need to be able to post that collateral, right? So that would settle one leg of the transaction. On the other side, the dealers might say, well, you know what? By the simple fact we are the dealers, so we are the first, which can actually get the pulse of the financial markets and the repo markets, right? If we expect liquidity to be lackluster, and therefore there will be some sort of a collateral shortage, what if we actually buy the collateral right now? We don't need that, right? I mean, we actually ask it in order to extend credit to other people. But think about it this way. The dealer can actually occupy the two legs of the transaction, right? At the end of the day, the dealer is kind of like a broker. So they say, all right, people will need it. So if I have it, what can I do after it's lended out? So on one side, I'm accepting collateral and lending money out to people. On the other side, I could also lend the collateral, right? It's a bit complicated when you start to put all the pieces together. You need to think with the head of the dealer, right? The dealer always occupies both, it sits in the middle, right? Basically. So there are many ways by which he can make money. He can lend actual money out, taking the collateral as guarantee and gaining the spread, right? The haircut. Okay. But since there is something in financial markets which is called collateral transformation, you could also find yourself into a position where you have a collateral. Let's say you have a lot of junk bonds, right? They might not be accepted as collateral, right? But what you could do is take a lot of junk bonds, going to a bank and saying, you know what, I got this collateral. It's not going to be accepted worldwide. So I would need to transform it in something which is perceived as more pristine. So let's say let's use round the numbers. I got these 100 bonds, junk bonds. If I post 100 junk bonds, right, how many US Treasuries are you going to lend me out? And they might say, well, for that notional value, again, 100, just figure of speech, right? For that 100 notional value of junk bonds, I might give you 80 notional value of US Treasuries. Now, then you got the US Treasuries, and then you can go in another part of the repo market actually asking for liquidity, because now your collateral will be actually accepted. So the dealer is still capturing a spread when he accepts the junk bonds and he gives you the pristine collateral. So as you can see, there are more ways for the dealers to make money still by kind of playing the same role, which is, again, the one of a broker. Like, at the end of the day, what they do is just being the intermediary for supply and demand, right? Just in this case, we're talking liquidity and collateral. So that would be it. Now, to close in, when you see these things going on, it means that there is a shortage, right? And therefore, people will act differently, and these might be the results of these dynamics at play, right? Or in plain English, since I understand I might not be the best at explaining it, you could just read what's going on, right? Written in plain English by someone which is actually a native English speaker, but at the end of the day, maybe with much more precise and concise words. The nutshell, the bottom of it, the core, it's still the same. Liquidity stress at the end of the day. And you see the Fed, which needs to intervene in order to support financial markets and provide the liquidity, which is not longer provided by those who would naturally do it. And why is that? Again, why wouldn't you provide the liquidity, although you get the collateral in return, right? So it's like your risk should be kind of covered. Well, it's because your risk perception is changing, and you think that even that collateral, as pristine as it might be, it's not enough at this point to cover for the risk that you perceive you are taking by lending money out to someone else. So either you ask more collateral, but if they don't have it, what do? They need to hoard it. What happens ultimately when you have people hoarding collateral? Well, there is an inverse relationship. So short-term bills and treasuries should go up, and therefore yields should go down. So this demand for collateral could be what's keeping the short end part of the curve a bit lower compared to the counterparties at the medium and long end. So huge talks. I hope I was clear enough. If not, default back to the last screenshot I showed. All right. Now, conversely, what we've seen in the bonds, like just looking at the futures, well, weakness, right? Because yields were going up at the medium and long end. So conversely, you should see the actual underlying going down, right? At the end of the day, I think this is not all. Like people have keep on saying throughout all the year that US Treasuries were dead, nobody wanted them, and even cash was trash, nobody wanted the dollar. Yeah, all right, maybe. But I think at the end of the day, that would be another narrative which has been defeated this year. Look at that. So this is, I guess, from the 29th or the 30th of December, so 2-3 days ago. But it looks like cash, maybe it's not really that trash if you are seeing record inflows in money market funds, right? So, I mean, not bad at the end of the day. What else? If you check globally what's going on, recently, beside the Chinese government bonds are actually outperforming the rest of the world. But let's just have a look at the US. And this is going on since basically 2022, 2023. Well, I mean, they are still in positive territory. So, it's not like they are keeping on going down. Sure, they are nowhere near the same levels they were before the pandemic. But at the end of the day, if you just look at them in the very short term, so over the last 2 years, they didn't necessarily, do badly. Not as bad as Germany or Japan, right? Now, again, there is an important distinction I think it's useful to point out. When you buy a treasury, and I guess this is where a lot of people get it wrong. When you buy a treasury or whatever other bonds, it doesn't have to be necessarily American. It could be German, it could be whatever. But you're not strictly buying it for price appreciation, right? Now, if it happens, that's it, that's the icing on the cake. But thinking about building up a portfolio and, deciding to put in an allocation, a percentage allocation to treasuries, you don't do it because you think that part will make you 5, 7, 8, 10% every year, right? In price appreciation. You do it because, well, first of all, it should lower the volatility of the portfolio, right? It should balance out the other risky assets you might get into it. You do it because no matter what you think, there is a certainty in the return of capital of that part of the portfolio because, at maturity, you're going to have all the money back plus interests, right? And, you do it to build up a portion of fixed income. Like, put it this way. Let's say you do your math, you know that throughout your investing life, you're going to need, your hurdle rate would be what? 6% every year, right? Let's say you're aiming to a 6% return, on average every year. Of course, there will be years where maybe your return is 3, there will be years where maybe your return is negative something, but there will be years where your overall return is like 10, 15, who knows. So, but let's say on average, you estimate you're going to need that. All right. So if you have US treasuries yielding you 4%, you take half of your money to be invested and you allocate them in US treasuries. What do? You have basically banked in 2% of the 6 that you need because, 4%, it's the yield. You just put in half of your capital, so that's half the return in total, 2%. Now you have to take way less risk in order to gather the remaining 6%, right? So I think that's the way you should look at bonds. It's not just how bonds are going up or down. At the end of the 2 years, 3 years, 5 years, 10 years, you're going to have the return of the capital plus the overall net interests you collected on it, right? And you achieve the result of having a lower volatility in your portfolio. So, also, beside exceptions, there are always exceptions, like we've seen throughout the pandemic. In times where risk on assets actually declined, right, you should have the bond components of your portfolio to keep it relatively stable. So kind of offsetting the losses that you may suffer in other sectors of your portfolio. But I think that's a much correct way of looking at bonds when you're thinking about structuring a portfolio. It's not about betting that the bonds that you bought, you're going to be able to sell them out in maybe 1, 2, 3 years at a much higher price. It's about the fixed income you're receiving and to lower the volatility of your portfolio. All right? That would be it for me, at the very least. But if you just look at the US Treasuries alone, right? Overall, they didn't do poorly, right? The 10-year returned you almost 8%, right? Now, obviously, I think they're talking about the total return, right? So again, price appreciation plus the coupons that you collected. I think that's the way they're trying to calculate that. Because I don't think the US Treasury, the 10 years actually up 10% for the year. We could try to go and look at it. That's year to date. We got just that, which is, wait a second. On a monthly chart, so the beginning of the year was in here, January. Where are we now? Oh, where we closed. Say we closed up 3%. And again, these are futures, so it doesn't necessarily reflect the the actual asset price movements. But, overall, it's unlikely that the actual treasury returned you more than 3 point something percent if the futures are here, right? So this is why I'm thinking these are calculating and including the coupons in this one, right? But anyway, it wasn't bad. Again, at the end of the day, if you got a bit of treasuries, they made you money, and they lowered the risk that you were taking in your portfolio. It's always nice to say, yeah, I would like a portfolio which makes me 25, 30% a year. Yeah, well, all right, but then what happens when you have something like April this year with the tariffs tantrum and all the rest? I mean, you might think that the stock market was down only 20%. If you wanted a portfolio which was able to return you 30%, 35% per year, you should have been taking way more risk than just holding the S&P 500, because you should have been overexposed to stocks like the tech sectors, which, if you go back and see, where they were throughout, all that period, yeah, maybe the S&P was down 20%, but a few stocks, the high beta, they were down from 30 to 40. So, just to remind you that if you want higher returns, you need to be able to stomach higher volatility, and not a lot of people are. They're good in saying it in the beginning, but then when the market is down 10, 15%, and the vast majority of their portfolio is down 40, 45, or 50%, it's a whole different game at that point. Our emotions catches up to you at that point, right? Ending up the bonds talks, going into next year, what we see is that there is a lot of short interest on bonds. They're taking the TLT here as, a reference point. Does it necessarily mean something? I mean, it just means that in the case you might see, a surge in bonds prices, there would be a lot of people which would need to cover. So usual talks about short squeezes and all the rest, which again, it is another thing which for me, it just highlights how bias can be difficult to defeat. Because just this week, and we're going to look at it in a minute, but just this week, everyone were talking about all these bullion banks being massively naked shorts on the metals. Therefore, if metals kept on going higher, they would have been forced to close out their short positions, and they would have fueled a much bigger spike to the upside in the metals. Yeah, I mean, but then again, those same people are those which tells you that bonds are dead. But if you're just looking at the financial instruments, if that dynamic of a short squeeze applies to metals, we're still talking money, we're still talking instruments, we're still talking margins. So, or margin calls. Why you should apply on metals, but treasuries are dead, doesn't matter. Even if they pump a little bit, it's going to be short-lived. Is it? Maybe. Or maybe not. I mean, I think the risk is just the same because the mechanics are just the same. So at the very least, they should be put in the same ballpark, right? All right. So enough of metals. Treasuries. Let's actually transition into metals. What do we see? Gold pulled back like a lot. And again, I wasn't expecting that huge drop. Which, it's a little bit my bad, because when I said that, I didn't consider that just a few minutes after it, I would have talked about, silver, the huge overextension in precious metals, and the potential margin increase to basically hold or open new leverage positions. So at the end of the day, lo and behold, it just took 24, 36 hours after I recorded and posted the video, and here it came, right? They immediately jumped up the margin requirements, and metals overall, not only gold, they had a little bit of a pullback. Now, again, before everyone freaks out, I mean, I'm saying it in a good way, right? It doesn't have to mean or to have a negative connotation. But before you start going like, yeah, but it is just short term, absolutely. I mean, I agree with that. It might just be short term volatility. I'm not saying this is the top for precious metals and they're gonna go down only from here. No, absolutely not. I'm actually still medium to long term bullish on precious metals. Yeah. All the talks of last week was just to highlight the fact that when things get spicy too much, when they get volatile too much, you're gonna see something like that happening. So what you're seeing here is that basically since the week opened up, gold came back down from the open to the lowest point, 6.20%. And again, we are talking about futures, right? Spot prices could be different because, again, now we have another debate, obviously. Like, yeah, silver is now what, 72? Yeah, but if you look at the spot price in Hong Kong, is 130. If you look at, I don't know, where was the other? Abu Dhabi, so in the Middle East, it's at 90. If you look in Tokyo, is 110. All right. But at the end of the day, me personally, I'm a trader. So, especially very short-term trader. So I'm not buying and selling physical gold every week of the year, right? I'm buying financial instruments or I'm selling financial instruments. So this is what I care for, right? These are the dynamics I care for, right? Don't really care how much people are paying for silver in Tokyo or Singapore or whatever. It doesn't impact me. Now, I mean, you could say, well, you will see when the monetary system see the reset, when you see the big kahuna coming out, it will impact you too. Maybe, probably, but, you know, I'm not a fortune teller. I'm not here to say if and when the current system will collapse, and if and when we're going to have another world war or whatever. Many different people, way smarter than me, kept on calling for the demise of the system, the death of the dollar, the end of American exceptionalism for 30 years, and Ray Dalio. And they've been wrong all along. So, you know, I'm not gonna challenge those very smart and highly educated people because, you know, if they are so smart and if they made millions and billions in these markets and even them got it wrong from time to time, who am I to, you know, to be so arrogant in saying that I'm going to get it right, right? All I was caring, it was to look at the short-term dynamics and implications of something like this happening and what could potentially be the risk of, you know, B coming after A, especially if we had a trigger, which ironically we had short after that. So, you know, that would be my thing. Now, is it gold in a bad situation now? I mean, we are still basically at support, right? We broke out for new all-time highs. And again, do you remember when we were saying, you know, if you're a mid to long-term investor or position trader, it's actually even better if it's going up slowly but surely like this, grinding up, because when you see moves like these, what usually happens is something like this. Case in point, moves like these are more often than not very quickly and sharply rebalanced by moves like these, right? Especially, again, if you have a catalyst, which, yeah, nobody could see coming, unless if you read an history book, right? But this is it. I think at the end of the day, I mean, this is not bad for gold. If we can base in here for a while and hold these levels, especially this area right here, the 4,200, right? That would be good. For now, if you zoom in, what we see is that we are basically moving in a range. in between 4,400 and 4,300 to the downside. So just wait and see if we can break to the upside, which means, getting back above these highs right in here, or if we manage to break to the downside. Although, I think the support to the downside, it's a bit stronger in my view compared to the resistance to the upside. So again, overall, I would say that in due time, but I'm still bullish oriented on gold up until the point something changes. This type of pullback, this type of volatility right in here is not enough, obviously, to invalidate a long-term trend like this one. Especially, it's pretty elementary, right? We are basically still going up when you start to look at things this way, right? So don't see any reason for it. Now, let's just have a look at the precious metals, the others. So silver in here, copper in here, and platinum, and ending up with palladium. So all of these, as you can see, since the open of the new week, silver was down from the open to the lowest point, which reached into 13%, more or less. Platinum was down 24%, right? And what else? Palladium went down 26%. Copper was a bit less volatile, but still down 5.5%. So again, my point stands. If you are playing with leverage, if you are playing with margin trading, all those things I was talking about, all of a sudden you kind of realize why they were important and why, when you need to assess the risk for what could happen, you need to pay attention to those dynamics. Look, again, I think I was clear enough, but I'm going to say it again. If you're just holding silver or gold or palladium or platinum or whatever for the long term, especially if it's physical, all of these, to you, it's just noise. Don't even pay attention to it, right? Just stick to your thesis, which, by the way, I would agree on for now. So don't be misled by other type of dynamics, which are more toward short-term speculators, right? So that would be it. If you see, let's take silver since it is the talk of the hour. If you see this one actually putting in a top and then breaking it, like let's say you might want to see, like, I think, let's say I'm bearish, right? Just for an example, let's say I have a bearish bias on silver after all which went on. So I might say, okay, this is my base right in here, right? And now I'm looking at lower highs being put in, and I'm still on this base. As soon as the base cracks, right? Let's say we go for another lower highs and then we crack it, we test it, and we go. That's when you really want to take profits on silver, because that would open up the gates for a much deeper retracement, right? Up until the point it doesn't happen, it's all well and good. I think it is actually better for a price chart if we can have a huge surge and then having a little bit of a consolidation, right? With the market going sideways for a while. That's building up volumes, that's building up acceptance to a new price level. That is good if you want to be bullish in the long run, right? Up until the point something changes, buckle up, because considering the amount of leverage and the amount of restrictions they are trying to put in on these ones, you could see another sharp drop. Again, could be another 5, 10, 15%, we don't know, but the risk would actually increase a hell of a lot more, right, if it happens. Okay, so, just to settle down the long discussion on silver and I hope nobody actually misunderstood what I was trying to say. Looking at some sort of a much more longer term, right, It's not really longer term, but let's just show it. Another risk, which is not only for gold or silver or precious metals in general, but it's for risk on assets. And by the way, yes, I think silver and gold are risk on assets the way they are trading right now, because at the end of the day, they don't guarantee you the return on capital, right? Like if I put money in a 2-year treasury bills, I know how much money I'm going to get back, and I know I'm going to get it back. So gold instead, well, it depends on price fluctuations. Doesn't pay me a coupon, doesn't pay me a dividend. So to me, it's just a risk on asset. And even more now that it's basically, as you can see, it's trading the same way equities are trading. And especially, after the bottom in October 2023. So the point it would be that if you were thinking, which by the way, you wouldn't be wrong, or think that was a thesis which was worth to be embraced, right? If you were thinking that gold was kind of like an insurance policy on your net worth, if you were thinking that, it might be a nice counterbalance to all the other risky bets that you had in your portfolio, the safe haven, the safe trade. When correlations start to tend toward one in between major risk on assets and gold, the problem is that if you have a turnaround in one of these, I think gold loses a lot of what, its diversification type of goals would have been, right? What you want to do when a huge percentage of your portfolio is going down, you would like to have on the other side something which is not correlated or negatively correlated to that portion so that it can balance out and offset the drawdown you're suffering. But if they both went up together to kind of the same magnitude, it's reasonable to think that let's always add in the if one of the two collapses, the other one might follow, right? If the correlation sticks, right? There is always the possibility that one of the two collapses and the other one keeps on going. Absolutely. It's just, they went literally parabolic all together. So I would have some reservation on it or some doubt. Especially again, because I think the vast majority of price appreciation in gold is due to speculative behaviors and margins and leverage and all the rest, right? And it's it's not me saying it, but if you look at the margin debt versus the S&P annual percentage return on, I think it's a return on capital, you see there is a very good correlation. The same one, kind of like there is on silver, right? Interesting. Well, look at that. It's on gold too. So, as if you needed any proof, right? Sure, again, people are buying it, central banks are hoarding it, whatever, but margin debt still plays a huge role into it, right? Because at the end of the day, what is margin debt? It's what allows you to increase liquidity levels in one specific market, and price is driven by liquidity at the end of the day. No more margin debt, no more liquidity, price should come down because there is nothing to sustain it up, right? And, I know it's going to sound like a troll. It's not my intention. I just found it interesting to one side, but also kind of funny. And it is this one right here, right? If you look at silver when it's adjusted for CPI, which again, just remember, it's we are all in agreement in saying that it's a measurement which actually underestimates inflation. Well, I mean, the question becomes, is it silver overbought, or did silver actually, maintain your purchasing power over the years? So for the long term, I guess it depends where you invested in it. If you're holding silver since basically the 80s, well, not so much, right? if you start piling in the latest 2010s, so after the financial crisis, yeah, then okay, it's doing a good job, right? Although, you had to suffer this huge drawdown in 2015, 16, 18, whatever, right? But if you believe in the long-term thesis, that's fine, I guess, for you. It wouldn't be for me, but, if it is for you, who am I to say no, right? But I guess, it is super funny because then you contrast that with how would equities, so the stock market, how would it have preserved and maintained your purchasing power? A hell of a lot more than silver, I'm telling you that. And quite honestly, over a long enough period of time, even more than gold. So again, this precious metal thing, yeah, maybe, again, if the system collapses, yeah, if we have a reset, okay. I'm just thinking, I might be too much of a practical guy. I might be too pragmatic. But I think if the system collapses and civilizations go fucked, I think what you would need to have is water and a gun and dry powder, not a stupid piece of metal, because you would have to face much bigger problems than having gold coins or silver coins or whatever, or diamonds. What matters? You check the price of diamonds and splunging. I guess it's not forever anymore, right? Even if you use it as a gift for your beloved spouse, right? Now, that's enough for me. Before I get too sarcastic, let's jump into the equity market. So let's try to make it quick. I don't think there is a lot to say about the equity market, at least for this week. The majority of it was red, of course, because we have seen another bearish week, although, again, short-term trading week. I think we're going to have much more clarity when basically all the big guys will get back to the desks next week at this point, as I said in the beginning. So let's just have a look at what happened. So you see that, since Monday, we immediately started to go down. Tuesday, it was a little bit of a ranging behavior, but, again, it's kind of the same thing we were discussing with, what was that? With gold, right? We came back down. We started to build up volumes. So we created acceptance below. And then again, we had another leg down. And, in between, basically, at the end of Tuesday and overnight on Wednesday, then, a little bit of a pullback throughout the London session on Wednesday, which, by the way, was what? Christmas Eve, right? This New Year's Eve, right? Yeah. And then down we went, and we ended up the year, closing down pretty badly, I would say, right? Look at that. We were basically down here, right? And here on NQ futures. So after that, we only traded on the 2nd of January, so basically yesterday. Huge pullback overnight, but then the US market opened up, a tiny bit of a spike to the upside. Probably we grabbed a little bit more of liquidity, or we retested back in a few levels to the upside. But anyway, we found resistance in here, basically where we broke down for NQ futures in here, right? The S&P was even weaker than that. All right. And, we just went down for the entirety of the session yesterday, right? So overall, when you zoom out, you see something like this, which it's kind of the same as what we've seen throughout the month of December. ES mini futures a bit stronger, right, compared to NQ futures. Ironically enough, the Dow behaved relatively better than NQ, and still relatively close to the highs. The Russell made these new highs, and then it came back down, and it's I guess in the context of this very short-term price segment right here, it's currently the weakest of the pack. Now, the problem when I'm talking about weakness, the real weakness which worries me, it's the one on the tech sector, right? And yeah, it looks like for now we are not really seeing a lot of love. I mean, don't get me wrong, it's not like it's collapsing or anything like that, but you know, even this one, another failure in making a new high in here. So, you know, it starts to become something like this where, you know, it's now, it's kind of going more in a wedge. If you want to draw it like this, right? So, yeah, once again, we bounced from the lower side of the wedge, but, you know, at this point, we are going to see a resolution. It's getting particularly tight now, right? Although, you know, it depends on how much you do believe in patterns. I'm not a pattern trader, but, you know, it just shows you that we are contracting with no clear direction. So up until the point we don't break with decision one way or the other, I think it's still in a limbo. You know, the S&P looks a bit better than this. Now, if you check the ETFs, what do we see? Kind of the same. If you look at the 21 moving average in yellow, the S&P bounced off of it once again yesterday, or at least it tried. We'll see if this bounce have a little bit of a continuation or not. Honestly, I'm not sure to see immediate strength in this one, but you know, I've been wrong in the past, especially because you know, it looks like momentum oscillators are trying to cross down once again. And even on this recent push to the upside, didn't see a lot of strength even in the MACD, in the histogram right in here. So, you know, would be a bit skeptical, although again, next week we are gonna have big guys coming back. So we will see where they're gonna put the money for Q1. The QQQs is a bit weaker, as you can see. It closed with a much bearish tone, and even the moving averages are, you know, it closed below them, closed below the 21, and it looks like we are going to have another pinch. Although, again, we've been discussing the relevancy of moving averages crossovers when you start to get into an environment which is mostly sideways. But it's undeniable that, you know, obviously, the Qs are relatively weaker for now. What do I have more? What's that? Well, this is the E-mini S&Ps, but let me check the index just to confirm one thing. I mean, I already know how it is. I just wanted to show you. But at the end of the day, if you look at the index, right, it closed positive for December. Slightly positive. It's not something to write home about, but nonetheless, it closed positive. So that would confirm that statistic about, you know, rarely we did see 2 Decembers in a row closing negatively. And it's confirmed even if you go here and check this one out, right? So you see that basically the month of December started where? In here. Let me check. Should be, yeah, should be this one. So 6,812, and we closed, as for the last day of the year, we closed at 6,845.50. So slightly above it. Again, not huge, but nonetheless, we closed above. I think, you know, let's stick to the index for now. I think one stat which will probably fail. I mean, we only have at this point two trading days, right? Because we only have Monday, Tuesday. It's the Santa Rally, right? Do you remember the Santa Rally was the last 5 trading days of the year and the first 3 trading days of the new year? So before getting into 2026, which ones were the last 5 trading days? So 1, 2, 3, 4, 5. This one right here. So basically Christmas Eve. So if you draw a line in here, we are below it. All right. Now, I mean, if you want to look at it with the proverbial glass half full, you might say, well, maybe it was just anticipated because we started rallying basically around the 19th, 20th of December. So maybe it was a little bit of a front run, but if you just stick to the stats historically, it looks like for now, that's not super cool. Again, as I was saying, we already had a good chunk of it, which is under the bridge now, but we still have 2 days. So what you would need is basically this market to have some sort of a very violent pump over the next 2 days, something like it, right? To say that Santa actually came to Broaden Wall. The historical returns were around 1.3, 1.4%. So again, unless we have that huge bump, I doubt that we are going to see them, at least, by judging things for what they are now. At the end of the day, even if, let's say, now we go up, big if, and we close, that period kind of like here, I mean, is it bad overall in the grand scheme of things for December? I mean, maybe not, but, let's say December starting here, that would put us at what? December returning 1.5%. And, still relatively close to the highs. So at this point, now that we finally have those historical seasonality gimmicks out of the way, we could just try to get back in focus with things which could actually impact the market a bit more fundamentally. I'm not saying that it was worthless to talk about the seasonality data and whatnot, but, it's gone now. So it was what it was. I think, if anything, it might have helped you out to, at the very least, not being overly bearish throughout this period. So therefore, not building up massive short positions on the market, and, take a little bit of your head over your shoulders, right? Now, what may come next? I think, let's have a look at a few slides in here. I think, again, people are projecting, as we were looking at, kind of like an economic renaissance with earnings growth coming back up in the majority of the stock market, which excludes basically the Max 7, right? So that should be a much broader type of earnings growth, which obviously it would be good for markets. Although, again, I have a lot of doubts on it, but yeah, sure. This one, it's what, as I said in the past, leaves me the more skeptical. But Wall Street analysts, I actually never seen them, ending up one year and then coming up with a forecast for next year and saying, "Oh, well, we think it's gonna be fucked." Otherwise, how can they sell you all those precious financial instruments they, collect a commission on, they make money off, right? I guess that was the point. But, we'll see what's going to come. I think at the end of the day, we were looking at the risks last week. Obviously, if they're all, well known, they are priced in, most likely. But let's have a look at these. Now, if you think that at the end of the day, we are going to have, a little bit of weakness in the economy, aka, as you can see in here, GDP and CPI, plus, a version of the PCE index coming back down, that should fit the narrative of slowing economic growth, right? Now, why is that important? Let's keep on going. Well, because usually there is a good enough correlation in between, GDP rates and inflation. So, you can't have one without the other. And if one of the two is going down, probably the other would follow. All right. Now, here's the point. Economic growth, and aka GDP, also impact what? Employment. And here's the, a very grim situation from my point of view on, the full-time employees, which are driving what? inflation and consumption, aka if they are consuming, they are generating economic growth, right? You need to have some degree of inflation if you want to have economic growth, because what's going to happen when you have inflation? Well, how can you have inflation in the first place? Well, you need to have higher salaries and wages. Therefore, people can buy more. If they can buy more, there's going to be more aggregate demand. On the other side, producers and manufacturers, they will see demand coming in, and they will what? Well, they will increase the prices. It's just supply and demand, and they will make more money, right? And they will invest more to bring on the market more supply, since they see the prices are higher now. And if they can increase the volumes they sell, they will make even more money. In order to do that, they need to invest. So maybe they invest in what? New machineries, infrastructure, new buildings, new offices, and new people. So more jobs, right? And what's going to come out of it? More inflation. Because people have more money to spend. There is more investment. There are more jobs, right? So prices will be driven higher. So saying that you don't want inflation, but at the same time you want economic growth, I think you can't have both, right? Or you cannot have one without the other, right? It is also important because the labor market, of course, as you can see, it's not in a very cool situation for now. When you look at the full-time employees relative to the average, the total working age population. So even in that, when we talk about unemployment, we would need to talk about the participation rate and all the rest, right? So, there's no need to repeat that the labor market, it's not as resilient as people say it was, right? But at the end of the day, why this macroeconomic landscape and environment is important to understand when you look at what could be the next year for the stock market. Well, again, just another grim type of explanation on how a lot of employment report were revised lower, right? But yeah, anyway, keep on going. It is important because where economic growth goes, so GDP, inflation, wages, employment, all the rest, right? It tends to be kind of very well correlated with what the S&P, aka the stock market, is going to do. So, and why is that? Because at the end of the day, again, fundamentally, we're not talking short-term liquidity dynamics. We are talking a little bit more long-term, right? In order to have stock prices to go up over time, so months, quarters, years, what you need to have? You need to have earnings growth. How can you have them? You need to have people willing and able to sustain aggregate demand. How do they do that? They need to have money to spend. How can they have more money to spend? Well, first of all, they need to have a job. So you know how it all links up, right? So if you're looking at a situation where economic growth, the labor market, inflation, it's slowing down, then again, you might be careful with, your predictions for the stock market, right, next year. I'm not saying it's going to crash, right? Not at all. But I'm just saying, if the fundamental drivers for that over the long run would be those, it doesn't look to me like they are on point for now. Although, again, we have been discussing many times how the stock market, especially recently, is decorrelating from the real economy, right? And you can clearly see it in here, especially after the pandemic, massive monetary interventions and all the rest, all right? Okay. So here we're looking at valuations, right? Which again, why valuations are based on forward and trailing operating earnings per share. So again, where do earnings come from? Consumption. We get back into the same, chain of events. Consumption comes to the ability of people to spend, which comes from jobs and yada, 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 right? So at the end of the day, right, I think next year it might be something like this. Also because in the midst of all these uncertainties about the economy, geopolitics, and all the rest, also the Fed, who's going to be the next Fed chair, right? tariffs will be tariffs, right? Declared not constitutional, aka not legit. Many different things, right? But if we want to get back to seasonality, so to speak, we see that midterm years, like it's going to be next year, are they usually see a much higher degree of volatility. So you are going to read of people being massively optimistic, and you're going to read about people being massively pessimistic. I'm just saying, just to underline the obvious, this year the market at the end of the day was up 16%. If you add in the dividend yields, we might get to 17, 18%, roughly, more or less, right? After 3 years where the market was up 20%. 2 years. It was up 20%. So at a point, will it be normal to have a year when you experience a bit more volatility and both the doom and gloom predictions and the rosy predictions come to fruition, right? What I'm saying is, it could be like this year. Maybe the market goes down at the beginning of the year, but then it ends up. Or maybe it goes up initially, but then in the second half of 2026, it comes back down, right? And at the end of the day, what may happen, it could be, subdued returns, right? It's just the law of large numbers, right? I think it's very hard, or at least, every single year it goes by and you score a 15, 20% annual return, the odds of the next year being another one of them, they start to decrease, in my view. So, just I don't have a clear outlook, if not much more volatility. So I'm kind of happy about it because I'm more of a trader than an investor. So, if the market is particularly volatile, that means more opportunities for me. But if you are an investor, the usual buy and hold might not be that funny. I guess, to some degree, it wasn't funny even this year because, if you buy and hold, seeing the market down 20, 25%, it might be harsh, right? So, again, this is, again, a representation of the seasonality cycle for the 4-year presidential cycle. And as you can see, it looks like with midterms next year, we could see something like that. So, maybe lower returns than expected, market being a little bit volatile, but overall doesn't necessarily mean we're going to see a crash, right? Now, they're placing like 2027, it's going to be the year of the bubble keep on expanding. I don't know about that. It's already enough to look at 2026, let alone 2027. And for me personally, it's already enough looking at the next month. What the fuck do I know about the next quarter, the next half year, the next year? I don't know shit about it, right? But just if I wasn't clear enough earlier on, right? But, it could be just a nice reference point, right? It's something that you want to keep in the back of your mind so that throughout the year, when you go through those 5, 7, 10% pullbacks, you're not pulling your hair and saying, this is it, this is the end is near, the usual, Homer Simpson GIF, right? Just to give it a little bit of perspective, right? Then what? This is interesting. Now we are going through rates cut cycle, right? Now, throughout history, there is a huge difference in the returns, right, of the S&P, depending on the fact that the rate cuts were due to a recession, or if there is no recession and it was just some sort of a normalization, so to speak, to use Jay Powell's terms, right? So even in this one, I guess the big distinction would be, will we enter a recession in 2026 or not? Because if we don't, at the end of the day, we keep on slowly cutting rates and the market should benefit from it. Maybe you're not going to see another 20% year, but, still positive returns for the year. If we have a recession, there is not a lot of reasons, or to explain why it would be negative for the markets, right? Although, again, even in a recession, I think there would be an opportunity, because if we have a recession and the market is down like 20, 25, 30%, what do you think is going to happen next? More of what happened in the past. More Fed interventions, more monetary stimulus. So that's not a bad dip to be bought for the long term, right? It's just a matter of understanding when the dip or the bottom is in and when the interventions are coming in. And at that point, you buy things on a chip, right? Which is why, again, if you kind of lean toward that outlook, is cash really trash? I mean, if you keep cash in a money market fund for even a year, in the grand scheme of things, are you really losing against inflation? I don't think so. Plus, you have optionality, right? Cash is optionality to buy things when they are cheap, when they are at a discount, which not only allows you to suffer, lesser initial drawdown on your entries, but it also increases massively your payoff if you're right eventually. So, it kind of skews the risk reward in your favor at the end of the day. So I don't think cash is trash. At least it's not now, in my view. What's next? Well, this is controversial in my view, because in years when you had more than 50% drawdowns, it looks like that's some sort of a reset of the stage, and the market comes always up, for double-digit returns. Now, this is a statistic which goes back to the 50s, obviously, but first of all, all of these were years after major recessions or crises, like 82. What do we got in 80, 81? All right. 2009. All right. What do you remember we got in 07, 08? 2020. No need to remember that. Everyone remembers that. 2025, the tariffs, and then the market rallied on. Okay. The only one thing of this stat is, again, that it tells you what happened after such sharp drawdowns, but it doesn't really tell you what was the situation before. In 2025, is the market overextended? AKA, are we coming off of 2 previous years of 20% plus returns? Yes. Was it the same in 2020 or 2009? Maybe. I don't know. On the top of my head, I can't remember. But I'm just saying, I'm probably going to do it after that. But you might want to check what the general tone of the market was before these events and the subsequent results actually came to fruition, in order to establish the validity or the efficacy of the stat for the current situation. All right? Just saying. No matter what, again, another myth or narrative which was debunked this year is that, sell America, nobody wants America, nobody wants the dollar, whatever. Well, but when you look at the net foreign purchase of US assets, it's not bad. They actually increased compared to 2024. So, maybe we foreigners, we do still want America, right? And again, you might say it's not, but betting on US assets, to some degree, it is also a bet on the dollar, right? Because they're all US dollar denominated assets at the end of the day. So, always pay attention to narratives, because then you get to the end of the year and you do realize that a lot of what you've read throughout the years, a lot of podcasts, a lot of YouTubers selling you the doom and gloom just to farm engagement, that's what they were, engagement farmers, right? Now that I think of it, yeah, am I basically, am I a YouTuber, first and foremost? I got 70 subs. So I'm not even a YouTuber. I'm just a muppet talking on the internet at the end of the day. But at least I give it my best effort to try to stay objective when I can, if I can. And I hope that, someone could actually call me out and actually give me an opportunity to learn something new. Let's try to end up quickly. We already went over it when we were talking about bonds. Again, another chance to take a screenshot, I guess, if you want it. This was just a screenshot of the December returns for the S&P. So nothing else. I think, closing down, next week's going to be the first week of the new year when, we actually have a full-on trading week with big guys, real market participants coming back in. So probably a lot of decisions will be made next week. So I think that's the real start of the trading year. And so I'm looking forward to it, to kind of grasp what the general tone for the market might be, in the month of January and potentially for Q1. We will see, and we will get back to it next week to see what went on. Up until that point, of course, as usual, have a nice weekend, have a nice Sunday, and most importantly, be nice and be cool. Peace out.
Shit, this is really gonna affect people.
Yeah, it's gonna affect people like me.
Well, real people.
Jesus, Seth. Listen, if you really want to do this with your life, you have to believe you're necessary, and you are. People want to live like this in their cars and their big fucking houses they can't even pay for, then you're necessary. The only reason that they all get to continue living like kings is because we got our fingers on the scales in their favor. I take my hand off when then the whole world gets really fucking fair, really fucking quickly, and nobody actually wants that. They say they do, but they don't. They want what we have to give them, but they also want to, play innocent and pretend they have no idea where it came from. Well, that's more hypocrisy than I'm willing to swallow, so fuck. Fuck normal people. The funny thing is, tomorrow if all of this goes tits up, they're gonna crucify us for being too reckless. But if we're wrong, and everything gets back on track, well then the same people are gonna laugh till they piss their pants because we're gonna look like the biggest pussies God ever let through the door.